Tesla has some very attractive options, and I've got an earnings play that's not only going to teach you guys some options better than anyone else on YouTube, but also make you some money. Before earnings, stocks have higher amounts of implied volatility. That means that options are more expensive since traders expect more risk due to earnings event. However, implied volatility is an option trader dream. It's absolutely amazing, and I'm going to cover different bullish trading strategies, one with call spreads and the other with put spreads. Implied volatility is the market's forecast of a likely movement in a stock's price. If a stock like Coke barely budges, then the implied volatility is very low and the options are pretty weak. But with something like Tesla, I'm going to show you how lucrative it is to trade Tesla options and get to retirement fast. Like the smash button for me real quick, and let's get prepared for learning some knowledge. All right, so here we have Tesla right here. It's at $741. If you look at the 1 month chart, it was as low as about $609 back at the end of March, and now it's trending higher. It's about $740. It's in the mid range, and I think it's gonna be pushing higher towards $800. So today, what I'm gonna be showing you is two different bullish strategies. And essentially, the reason why I'm doing two bullish strategies is I believe that Tesla will go towards $800 per share. However, I'm not sure. I'm gonna show you guys a strategy where even if it falls to about 730, 720, 710, you're still gonna make money even if it has a slight pullback. So these two strategies are both bullish. It doesn't necessarily mean that the stock has to rise, which means that one of these strategies that I'm gonna cover second is a fantastic strategy for collecting premium. And by the way, you do not need a lot of money. I'm gonna show you guys exactly how to make a lot of money without having to put a lot of money in, which is the fantastic part. This is kind of complicated. However, I'm gonna break it down so easy. You're gonna be so happy that you watched this whole video. And essentially the first topic I wanna talk about is bull call spreads. So a bull call spread is when you buy two different call options, okay? You buy one call option, which would kind of cost you a lot of money. If we were to take a look at Tesla's options right here, if we were to bet on April 30th, okay, that does capture earnings. So you want to capture earnings. Earnings are on April 26th. So you want to capture the next option that's available that includes earnings. So April 30 would be the sweet spot for us. And let's say you're going to buy the 750 call. What that means is, and if you want a video, you can watch one right here, but essentially when you buy call options, you're betting that a stock will go up. You're betting on the strike price of 750. However, here's the issue, and I'm gonna solve the best issue that could possibly happen with an option trader who doesn't really wanna put up a lot of capital. So here, the 750 call is $31.75. And if I click this right here and I click continue, and I put one contract in, that's $3,170. First of all, that's not a lot of money. However, I'm gonna show you how to reduce this tremendously. So basically with a bull call spread, rather than just owning the call option, you're gonna actually end up selling a call option that's a little bit farther out of the money. I'm gonna show you exactly what that means. So here, rather than just owning a call option for 750, on Robinhood, you can go to sell. So now you're gonna sell a call. So 755, you can go right here and click sell call. Now, what happens is, let me explain. When you buy a call at 750, you're participating on all of the upside. However, now that I sold a 755 call, you can no longer participate on the upside above 755. However, the beauty is that you actually end up collecting a lot of premium. So right here, you guys can see it's $29.55. Essentially, you're paying $31.75 to enter into the call option. However, now you're actually getting $29.55, and this is called a bull call spread. The reason it's a bull call spread is because this is a bullish strategy. If Tesla goes past 750, you will be participating from 750 to 755. Your potential gain is $5, and of course each option is worth 100 shares, so you can potentially make $500. Now I want to show you guys how much this costs, and you can actually see it on my screen right here. This is called call debit spread, which is the same thing as a bull call spread. Now here you would be paying $218 or $220, but I just told you guys that you can make 500. So the way that happens is if Tesla goes past 755 and it ends up staying there at expiration, of course, before expiration, if Tesla goes towards that mark, you will be making money. But I'm going to talk about at expiration just to make things even more simple. At expiration, let's say Tesla ends at $760. You will make $5. You invested $220. You would have more than doubled your money in less than a week. So this is a strategy that is a little bit more risky because the downside is if Tesla ends at $743 and say it doesn't go past 750, then you don't end up making any money and you actually end up losing the premium that you paid. So the downside is you can lose $220 that you pay. However, the good side is if you have conviction and you believe that Tesla is going up, you can create this position and you can actually double your money in just about a week's span. So what I really like about call debit spreads or bull call spreads is they're an easy way to bet on a stock doing something and you don't need a whole lot of money. I mean, $223, this is essentially the options of options because the option was like $3,100 something. Here it's like $220 and you can still double your money. So basically this is one tool in my toolkit that I teach in my weekly option academy, but I think this is one of the best things that you can do, especially if you're bullish on a stock. So one more thing that you have to know about bull call spreads is you can actually close that bull call spread. You can close it for a profit anytime before it even expires. So if you open up the bull call spread and on Monday Tesla ends up going up and you make some money, you can get closer to maybe $400 or even $450 before expiration and just close out that option and do whatever you want with that profit. However, I would recommend just holding the position up until expiration. What I usually end up doing is I wait until Friday, and when I made most of my profits, I just close the position so Robinhood doesn't close it for me. Now, the next thing that I want to talk about is a put credit spread. A put credit spread is kind of similar to a bull call spread in the sense that you again open up two different options and they're going to be two different puts. And some of you guys are going to say, but Henry, a put is a bearish strategy. No. Not in this case. I'm going to show you how to do a put credit spread by being bullish. So let me get out of this call debit spread and I'm going to exit out of these two. And if you go to sell put, okay, I'm going to do the same expiration date because again, the reason I'm going April 30 is because we want to capture the earnings of Tesla. If you were to do this on the 23rd, well, the option wouldn't capture Tesla's earnings. So you would not be capitalizing on the implied volatility of the option before earnings. So before I was showing you guys that a bull call spread, you buy 750 and you sell 755 and you're going to make the profit. The difference right here is what you make. With a put credit spread, it's actually a little bit different. What you're actually hoping is that the stock does not fall, and if it doesn't fall, you end up making money. Again, you don't want it to fall, and if it does fall, then you're gonna be losing the amount of capital that someone else is betting on. With a put credit spread, you're kind of doing the opposite of a bull call spread in the sense that you're selling two different options, but this time you hope that these options do not go into the money, because if they do go into the money, you will end up losing. So in this scenario, you don't want Tesla stock to fall. Again, hence the bullish strategy. If Tesla stays the same or goes up, this strategy ends up making money. So the way this works is essentially you're gonna find a strike. I'm gonna show you guys real quick what I look for in a strike. So I'm gonna go down here because I wanna be safe. So I'm gonna go enough out of the money to have some safety. If I click here, perfect. There's a good amount of volume. There's 1,000 contracts traded, which is a very healthy amount. Anything over 100 is very good. There's a lot of open interest. Implied volatility is very healthy. If you take a look at something like a Coca-Cola, it probably has like 30 or maybe 35% volatility. However, with Tesla, it has 78% volatility, which is a fantastic thing for an option seller or any option trader for that matter, if you know what you're doing. So implied volatility is very healthy. Now, what I also look for is the delta. Here we have a 0.28 delta, guys, and what that means is there's a 28% chance of this option getting down to $700. That is very good odds, because that means on the flip side, this is going to be about a 72% chance of you guys winning. So what you end up doing when you sell a put credit spread, here you're going to be collecting premium. So on the bull call side, you were spending money to buy a call option, and then you were subsidizing that call option by selling another call option that was out of the money. Here, what you're doing with a put credit spread is that you're going to be collecting premium right away. So you're going to actually sell this $16.35 right here, and that's what you're going to be collecting. However, the issue is if you're going to be selling a put option or you're going to be short a put option, you want to have a cash secured option. I never recommend people trade on margin or not have cash secured positions. So in this case scenario, a 700 put would cost you $70,000. And wait, hold up before you click off the video. I understand that's a lot of money, so I'm not going to recommend that. I'm not going to make you guys sell some puts because that's a very expensive strategy. Instead, you can also have a $500 put spread. And what that means is now you go to buy put, and here I'm going to click on the 695 put, and I'm going to click here. It's $15.05. And what happens here is you've sold this option at 700. However, because you don't want to obligate yourself to have $70,000 reserved for a cash secured put, you're creating a put spread by buying 695. What ends up happening is you have that little gap again between 700 and 695. That's a $5 spread, or about a $500 worth of risk or worth of profit if you're doing a bull call spread. In this case scenario, you have a risk of $500 because if Tesla were to fall, then you would lose the amount between 700 and $695. So here, your potential loss is $500. However, if I click this option right here and you're gonna be buying it, you can see that it says put credit spread. And in this case scenario, it says total credit. Before, with the bull call spread, you were paying money. It was a debit and not a credit. You were paying money of $220 and you were hoping to get $500 so you can double your money. Now, in this case scenario where you have a put credit spread, you're actually doing kind of the opposite. You are actually collecting a credit up front. So up front, you will get paid $162. So $162 goes right into your account. You can do whatever you want with it. You can withdraw it and go out and get some ice cream, whatever you like to do with the money. But with $160, you actually collect it up front right away. Now the risk is that you have $500 as a potential risk, but actually the maximum you could lose here, because you can lose potentially $500, but you have already collected $160, would only be $340. 500 minus 160, 340. So in this case scenario, I also like this strategy a lot because you end up profiting if Tesla stays above $700. Now you guys might be thinking, well, you can lose 500, but I'm only making 160, or I can lose 340, but I'm only making 160. So what is the good in that? I can't double my money. Well, let me tell you why you would want to do that. Basically, Tesla's $742. Do you guys really think that Tesla is going to fall down to 700? Well, it could, right? It is potential that it can fall to 700. However, if Tesla falls to 732, a stockholder lost 10 bucks. If it falls to 722, a stockholder lost 20 bucks. But look at yourself, you have made money. If Tesla falls to 730, to 720, to 710, it doesn't matter until Tesla falls below 700 and then you will start to lose money. However, everything above $700, you get to keep your 160. By the way, you get to keep the 160 either way, whether that happens or not. But with Tesla, if it goes below 700, you'll see some losses. However, your max loss is only at $500, or the difference between the 500 and the 160 that you collect, $340. If Tesla were to go to zero, which by the way, I can't imagine that happening, obviously. If it were to go to 100, that's not gonna happen. But if it did, for whatever reason, there was some bankruptcy or something crazy happened, or actually went down to $500 per share by next week, you would only be hurt $500, or the difference $340. You would not be hurt past $695 because you have a put credit spread. That 700 that you sold, you're being covered by the 695 put because you've sold the 700, but you're long the 695. If it were to go down to zero, you would lose $70,000 on the put side, but you would make $69,500 on the other put side. So you would only have a difference of 500. All right, guys, so let me actually go ahead and execute this. So we have the 700 put, we have the 695 put right here. I'm gonna click continue. And I'm gonna do one contract. So one contract is usually 100 shares of each. However, here you don't really have to worry about having 100 shares of anything because with any spread, you actually are covered. So you no longer need 100 shares. So here the bid is 135 and the ask is 180, or it was at least. So what I will do here is I'm gonna go somewhere in between. So in between would be 160. However, I do wanna get filled. So I'm just gonna go with 155 and I'm gonna click review order. And typically it says that you have to have 100 shares, but here we see collateral $500. So I told you guys, it's only $500 worth of risk. And there we go, guys, we got filled. So Tesla put credit spread was filled, $155. So $155 got credited to my account, and my account actually took a $500 risk. All right, so let me go ahead and execute this trade again. So we're gonna buy the 750 and we're gonna click sell right here, and I'm gonna go 755 and sell that. Now we're gonna do one contract. So again, one contract is usually worth 100 shares in the options world. However, with a call debit spread, you do not need 100 shares. You just open up this bull call spread by itself and you only need $218. So I usually look over here, I look at the bid and the ask. Here, you always wanna go closer to the bid when you're buying and you always wanna go closer to the ask when you're selling. But usually you wanna be somewhere in between to get executed, because right now, if I were to bet 190, I would not get filled. That's why Robinhood is actually recommending that I go with 220. So what I'm gonna do is I'm gonna go with 215 and we're gonna try to execute this at around 215. Review order and submit. So guys, this is a very good example. I did not get filled. So what I'm gonna do is I'm gonna replace order. I'm gonna click continue, and 215 was too low. So I'm gonna go with 220, submit. Boom, I got filled. So $500 in my potential reward and I spent $220. So here I'm looking to at least double my money. Now, these two strategies are phenomenal strategies because you don't have to put that much money. In one case, you had to put $220, and in this case, you have to put $340. So this is a fantastic way to grow a small account. If you have a small account and you were scared of options before, and you were just buying call options, which is a awful strategy, by the way, because so many people do that, they end up losing money. I would try this instead, where you're selling options or you're betting on a stock doing something with bull call spreads. This way you have a lot less risk and you have a lot more reward, and you can also get good at options much quicker. If you want more information, check out the Weekly Option Income Academy below. Thank you for watching. I'll see you guys in the next one.